Now our top line story. Stock market investors are once again reeling, wondering what it will take for markets to get beyond the apprehension of higher for longer interest rates. Canada's benchmark stock index, the S&P TSX Composite Index, has plunged by more than 1,000 points or 5% during the past 7 trading sessions alone. Here's a look at the most influential losers over that period of time: Shopify, Brookfield Corporation, CP Kansas City, Royal Bank, and TD Bank. It looks like a broadly based decline. A tech bellwether, financials, and a transport name all losing significant value over the past week. For insight, let's bring in our featured guest of the morning. He's Paul Harris, partner and portfolio manager at Harris Douglas Asset Management and a longtime guest on our show. Thanks for coming in. It's great to see you. I hope you had a good summer.
I did.
What's going on the S&P TSX Composite Index?
So technically, September is actually the worst month as opposed to October. People always think of October as the worst month, but September is actually not a good month as a general rule. Outside of that, I think the problem is that with one of the things is that monetary policy, the way it lags and all that stuff, really, if you're going to have a difficult time in an economy, it's not when the Fed raises rates right away. It's sometime past that point in time. And I think people are realizing that maybe we're at a point in time where you're going to see a lot of difficult things happen in the economy, and maybe this slowdown or this recession that people were talking about, right? So I think that's one thing we're in a difficult environment. And you saw inflation come down quite aggressively over the year, but now it's sort of ticking back up again. And so people are really unsure, just because they didn't raise rates, that they're not going to raise rates more. And I think my feeling with this is that that the Fed and the Bank of Canada and other central banks should raise rates to a level where inflation gets back to their target level. And when you say should, that you believe that's the right course of action, rather than a prediction of what they will actually do, or is it both? No, I think I think they should actually do it. I think they should actually raise rates until they kind of dampen inflation and dampen inflationary expectations. I know that's a difficult thing, right? But the reality is that if we don't do that, inflation is a bad thing at a sustained level. A little bit of inflation is good. Too much inflation is bad, obviously. And so we need to get it to a level. And the world, the central banks around the world decide that 2% is the number. So I think that's what they have to get it back to. It's something very close to that, and make sure it's sustainable. And the only way to do that is to really increase interest rates. And so I think we're in this kind of weird zone where, yes, unemployment hasn't. If I told you, Paul, a year ago that they're going to increase rates by 5% and unemployment was going to stay around the same levels, you'd say, Paul, you're nut, right? So, but that's what's actually happened. So they've got some wiggle room here to actually do some of this stuff and maybe not cause the damage that they were thinking that they were going to cause when they raised it 5%. So there's this opportunity, I think, to dampen inflation and get the economy back to the liquidity in the economy back to a level where it should have been years and years ago, but it wasn't. There seem to be an increasing number of people who disagree with you on the right course of action on central banks. They say that a recession is a real possibility if, for instance, more and more people have to pay much more money to service their mortgages, and therefore much less on discretionary items in the economy. Right. So I think you saw that even Costco mentioned that discretionary items are down, whereas essentials are up, and that's obviously what's happening. It doesn't mean that. So the issue with mortgages in this country specifically is the more people did variable than they did. And the higher rates in the United States have not hurt the mortgage business there. It's really because most of them locked in for 25 years, right? So in this country, there's more variable rate mortgages, and you're seeing a much more difficult time. But to me, it's not that the rates are going to go up another 5% or 4%. It's going to go up another 50 basis points, 75 basis points, and they probably get to where they want to be. And that may cause a mild recession in our economy. And I think that I understand that's a difficult thing for an economy, but it's probably better than having a sustained rate of inflation that may even go higher and force them to even push up rates even more. So saying all that, I think the bond market there's an opportunity in the bond market, specifically on corporate debt, where you're seeing a lot of corporate debt trading at big discounts to their par value. So there's an opportunity to be in the bond market at these levels. I'm not sure where rates are going to peak, but it's somewhere around these levels rates are going to peak, and so they may stay there for a little bit longer, but there's an opportunity to pick up a much higher yield in the bond market. And as you've seen in just even GICs and stuff like that, they're paying much higher rates than they were. But I think the bigger issue is that the rates that we saw for 20 years or 10 years, I guess, from 2008 on were not sustainable. They were just they were there for reasons of market reasons that caused that to happen, and even in 2020. But that's not a sustainable rate level, right? The rate level should be somewhere higher than where it is. I'm not sure what that number is. But it also, the impact that has on the stock market is that people have to reassess valuation of the stock market. So at 1% interest rates, you can value a company very differently than at 4% interest rates, right? So I think that's what also is happening in the stock market, is that there's a kind of understanding that things have to be reevaluated in a proper way, and that takes time for it to happen. And so that's why you're seeing volatility. With respect to the TSX, I mean, there's a sense that we are maybe going into a weaker economic growth, and we're a very cyclical economy here. So you end up having, and you don't have as much defensives in our sector as you do. You know, you mostly have oil, or you have banks. So a lot more cyclical metals, and so you have a lot more cyclicals. And so I think that's what's really hurting the TSX. And in the banks specifically, I think there's some feeling that the banks are like U.S. banks, and we're not like U.S. banks in any way or form. We are very different, and I think that this is part of the problem. We get dumped in. We're not a regional bank in the United States, right?
We'll talk about the banks in our next segment, because you like where they're valued right now. You think they pose opportunities for investors. Here's a question for you. We're seeing unions win significant wage gains. We saw it earlier this year with federal government workers. We're seeing it with auto workers, likely to see it repeated at Ford, at GM and Stellantis here. Quite possibly in the U.S., that large group of workers will lock in bid wage gains. Will that make the fight against inflation that much more difficult?
Well, so obviously, when you have an increase, so it all depends on how that increase happens, right? So is it a sort of system like they had in the 1970s, where there was a cost of living increase constantly that caused an expectation of inflation to be higher? That was. I don't think that's happening. I think this is much more of a one-time thing where they're saying, I need to catch up because I was so far behind the 8 ball a long time ago. So I think workers were kind of their real wage growth was not happening, and so I think that's what they're trying to achieve right now. But I think that if it's more about, oh, I'm putting this cost of living increase into my contract, and every time inflation ticks up, I'm going to get more money, all that sort of stuff. That really is what caused all the problems in inflation in the 1970s and 80s. And that I don't think is happening. It's more of a one-time thing where, we need to get paid higher, like the pilots, et cetera. So a one-time increase, and you're not going to probably see those large increases over every year, right? So, I mean, that would be very difficult if that was a part of the contract dealing. But I think, one-time thing increases like that don't make that much of a difference, right? They kind of flow through the system and get out of the system. So I think that's what's important about it. So, but saying all that, there are these little things that are happening that are keeping inflation slightly higher. And so therefore the Federal Reserve and Bank of Canada and the ECB have to deal with those things, right? And say, okay, is this a one-time thing? Is this a continuous thing? And that's what I think they need to do.
Okay, that's